Over the past decade, I've helped thousands of clients structure life insurance legally to reduce their tax burden and retain more of their wealth. So in this video, I'll show you 7 steps that the top 1% use with life insurance to minimize their taxes. First, most people think life insurance only pays when they die, but those who understand the product have been growing their money tax-free for a long time. So in 2024, someone reached out to our company who had a very high net worth and is extremely intelligent when it comes to all things finance. Now, he knew what cash value life insurance was, but he did not know how the product could be set up. So after learning all about whole life insurance and the cash value, he decided to put $2 million into a policy. Here's why. He lives in New York and he's in the highest tax bracket. The life insurance policy he got will earn about 5.5% per year, but that's tax-free. So here's how the taxes work with cash value life insurance. The money he pays in is with after-tax dollars. The growth is tax-deferred, but you can access the cash value tax-free, provided we follow IRS rules. So where can you put your money that's safe, liquid, and still get some decent growth? Money markets, CDs, treasuries, maybe fixed annuities. All of those might get you somewhere around 4 to 5%. The hard part with all of those assets, though, are the taxes. If I have money in treasuries, for example, I have to pay ordinary income tax on the gains every single year. So if I'm in a high tax bracket and I'm earning 5% with treasuries, after tax, I might earn closer to 3%. There's a big difference with the headline rate of return and the true after-tax rate of return. Here's a quick example of how compounding works. You're going to put $1 million into treasuries and 5% of $1 million is $50,000. That's really good for a safe place to put money. Now, if you're in the highest tax rate, being 40%, what that means is the taxes you'll owe for the year will be $20,000, which means the true net result after I pay those taxes is going to be $30,000. Whereas with a whole life insurance policy, it's different. So with a whole life insurance policy, I can see the cash value grow right around the same 5% per year. So if I have the same $1 million balance earning 5%, that's $50,000. If I'm in a 40% tax bracket, the taxes I owe with a life insurance policy is 0 because of how the cash value is treated by the IRS. So now with a life insurance policy, my net result is $50,000. I don't have to worry about a big chunk of my money going to the IRS. Here's the most important thing that almost everyone misses: choosing the right company and setting the policy up for cash value. The 4 major mutuals are Mass Mutual, Guardian, New York Life, and Northwestern Mutual. Those companies can show that their policies have truly delivered over time, and they also pay the lowest commissions. Now, when I say make sure that the policy is set up right, what that means is that I want to see somewhere between 80 to 90% of what you paid show up in cash value immediately and have a positive cash value somewhere between 3 to 5 years. So here we've got a policy with someone funding $10,000 per year. When we look at the first year cash value, it's almost $8,800, or 88% of what he paid into the policy in the first year. By the third year, how much has he paid? $30,000. How much does he have? Just under $30,000. And by year 4, he's paid $40,000 and he has more than $40,000. This is being cash positive between 3 and 5 years. I also like to refer to this as the break-even point. Second, the death benefit being income tax-free is real, but that's only half the tax conversation, and the half most people skip is the most expensive one. So I recently met a client named John who owns 12 hotels and has about 300 employees. Now, he has about $17 million in treasuries, earning around 4%. He just started a life insurance policy, and if we look at the cash value, the growth of his money now shifts from taxable to tax deferred, and accessing his money shifts to tax-free. For John, it's not all about the cash value. Because when John and his wife die, eventually everything goes to his kids. The kids will have what is called an estate tax problem. Pretend for a moment that John's net worth is $100 million. So up at the top, we've got mom and dad, and we've got their $100 million real estate empire. Now, when they eventually pass, that empire is going to be passed to you. Now, $100 million exceeds the estate tax limit, which means you have to pay estate taxes on this $100 million. So the current estate tax rate is 40%. 40% of $100 million is $40 million. Both mom and dad can gift you up to the lifetime gift tax exclusion, which currently is $15 million. So that means mom can gift you $15 million and dad can also gift $15 million. So the total gift is $30 million. And if they have not used up any of that lifetime gift tax exclusion, that can be passed when they eventually die. So what that means is you received a $100 million real estate portfolio. You don't have to pay estate taxes on all of it because $30 million can be knocked off of the taxable estate. So what this means is that the taxable estate from the IRS perspective is $70 million. The estate tax is 40%, and 40% of $70 million is $28 million. So again, if you received this real estate and you did not receive any cash with it, here's the question you are going to be faced with. How do I pay this tax bill? And the answer is either A, I sell some of the assets, or B, I take on debt, meaning I take a loan, perhaps against the real estate, to pay the IRS tax bill. So what's the solution? Life insurance. Here's the third piece. The single most important decision in any life insurance estate plan has nothing to do with the policy. It has to do with who owns the policy. We've got John. He gets a life insurance policy with a death benefit of $30 million. He does not own the policy. The owner of the life insurance policy is what is called an ILIT, which stands for Irrevocable Life Insurance Trust. The ILIT, again, is the owner of the policy, and it's also the beneficiary of the policy, which means when John dies, that $30 million life insurance benefit is not paid to John's family, it's paid to the Irrevocable Life Insurance Trust, which can ultimately benefit John's family. But why he does this and why families do this is because the trust is owned outside of John's estate, which means I do not have to deal with the estate tax issue in this particular case. So now I can use that $30 million to pay the $28 million estate tax bill we spoke of earlier. Here is the super important piece. Make sure you have a good attorney or estate planner, and make sure you have a really good insurance agent or advisor. I remember a young guy who had an estate planner who recommended he get a $150 million life insurance policy. The estate attorney referred him to someone that they thought was a good life insurance agent. The agent sold the young man a policy that costs $7.6 million per year. That policy was not set up in the young man's best interest, and he had doubts about it only a year and a half in, but he was forced to keep paying the premium or lose a lot of money. So before I start a policy, personally, I would interview multiple agents and I would not move forward until I know what I'm getting. Fourth, the IRS allows $19,000 per donor, per beneficiary, per year. And most families are barely utilizing a fraction of what that actually makes possible when it comes to structuring it inside of a trust. Here's how wealthy families move money tax-free while they're alive. The thing is, if I don't want to use up my $15 million gift tax exemption, I need to do things differently. So based on the current limits, you can gift up to $19,000 per year without impacting your $15 million limit at all. Here's how families will gift money to a trust. The trust has what are called donors and beneficiaries. Each donor can make a gift of up to $19,000 per year to each beneficiary without it counting against their $15 million limit. Pretend that John has just one son, and his son is a beneficiary of the trust. John, a donor, can gift $19,000 per year. John's wife, a donor, can do the same. John's mom, a donor, can do the same, and so can John's dad. That's $19,000 times 4 people, which is a total of $76,000 per year. If John has 2 kids, you would double it, which gives you a total of $152,000 per year. If he has 4 kids, you would double it again. And because it is not part of John's taxable estate, it's also estate tax-free in this case. So going back to the $100 million real estate empire that you inherited, you had to pay a $28 million estate tax bill. But the life insurance policy that John took out that the trust owned was $30 million. That $30 million was used to pay that $28 million estate tax bill. Fifth, once the cash value is built up, you can borrow against it to fund real investments. The policy loan isn't taxable, and the repayment is not taxed either. Most people I know who are putting large amounts of money into life insurance don't want to pay a premium their entire life. Someone has a big pile of cash sitting in the bank. Say it's $1 million. They hear about cash value and learn that it's a safe place to put money. It's tax-free if we follow IRS rules, and it's also easy to access. The first question they ask is, can I just write a check for $1 million, put it into the policy, and be done with the funding? You can, but the numbers don't look that good. So instead, they move $1 million into a policy, call it over 4 years. Then step 2 for someone like this is being able to use the cash value. If we look at the same policy, but an example of loans, we can see exactly how they use the policy and how loans impact the policy cash value and death benefit. So to the left, you've got the exact same illustration, and that shows what things look like if he just parks money and lets it sit and grow. Look at year 6. What you'll notice here is he takes a $500,000 loan. If this is me, I'm asking, how does that $500,000 loan impact my life insurance policy? Well, look at your cash value and life insurance policy amount, and then compare those values with the illustration where you never touched it. What do you notice? They're just about $500,000 less. Now in this example, he repays the loan at $100K per year. He does not have to do that. I put $100K per year to make this example simple. But he's not paying anything at this point in time, which makes it easier for him to do that. But when the loan is paid back, what's your cash value? What's your death benefit? And what does that look like when you compare that with the example where he just parked money and let it sit and grow? Everything's exactly the same. The money kept on compounding even though he accessed the cash value. What I've seen so many business owners we work with do is set up a whole life insurance policy and use the cash value as their own source of financing for opportunities so they don't have to deal with banks or lenders anymore. Number 6, when the trust uses the cash value to acquire assets, it becomes its own financial entity. Here's how wealthy families will often use trusts. Say I have a trust. The trust owns assets. It could be cash value life insurance. It could also be real estate, stocks, bonds, or anything. Now, I want my family to be responsible, so I say, kids, you can use the money, but you have to follow the rules. The money can only be used for business or investment opportunities. So if my son Jack says, I want to buy a $500,000 investment property, here are the steps he needs to follow. 1, it needs to be approved by the board members, which could be a combination of family members and outside advisors. 2, if everyone says yes, then the trust will acquire that investment property. It's going to be owned by the trust, not by Jack, because this will keep wealth in the family. The trust gives you control. It owns everything, so it's out of your name. But the thing that I think is most valuable here is the responsibility piece. Jack can't go out and spend $500,000 on a fancy car or a big beachside mansion to impress his friends. You can't do that. You can write language in the trust that ensures that the money is used the same way it would be used if you were still alive and calling the shots. So here's what I would do. Before your next investment decision, ask, do I want to own this, or do I want the trust to own this? Then ask, if I'm not alive and my kids wanted to invest in this, what steps would I want them to take? Does my trust have language in it that makes sure that this will happen? And do I have responsible board members that can help my family really make the right decisions? Finally, the one that turns everything you built into something that outlasts you. The death benefit that ends your chapter can be written into your documents to give the next generation a massive head start. If we go back to John, he had this big life insurance policy, and at age 90, the life insurance is worth $30 million. When he dies, the death benefit is paid to the trust, tax-free. Now, what happens first? If a policy loan is outstanding, that will be deducted from the death benefit. Second, the trust documents have a provision that directs where some of the money goes. For example, some of the death benefit from John's policy can be used to start new policies on family members, which continues the cycle. So for example, if you have 2 kids and 3 grandchildren, some of the life insurance proceeds from John's policy can be used to start new policies for them. The trust can also use the cash value in those policies for business opportunities, which ultimately will grow the family net worth even further. And when each family member passes, the death benefit is paid back to the trust, income tax-free, and if things are structured right, estate tax-free. Here's a way you can start simple. When you get a life insurance policy, you don't have to have a trust own it or anything like that. You can own it personally, and you can make your family the beneficiary. When you eventually set up a trust, you can change the beneficiary of your policy to the trust at that time. Changing beneficiaries is very easy to do. And if you end up having a ultra high net worth, well, you can always look to transfer ownership down the road. If you'd like to see a diagram of what this looks like, leave a comment below and I can work on a case study, as this is something I have a ton of fun with. If this made sense to you and you're serious about building a financial structure that actually works long term, this next video is going to be worth your time.